Good evening, everyone. A very warm welcome to all of you. My name is Ashish Patil, and I am Senior Vice President at Bandhan AMC. It is my privilege to host today's session. We are pleased to have us with us today Mr. Viraj Kulkarni, who is Fund Manager at Bandhan Mutual Fund and manages the Bandhan Healthcare Fund. Over the course of this call, he will be sharing views on healthcare sector and Bandhan Healthcare Fund's philosophy and current positioning of the fund. Please note that at this moment all participants are in a listen-only mode. Do note that this conference is recorded. There will be a Q&A segment towards the end, during which you can ask questions by using the chat function. Please note that mutual fund investments are subject to market risk. Read all scheme-related documents carefully. Sharing, forwarding, circulating, or otherwise making available to anyone is strictly prohibited. Without further delay, I would now like to invite Mr. Viraj Kulkarni to take the session forward. Over to you, Viraj.
Thank you, Ashish, and thank you everyone for joining in. Also, thanks everyone for your support during the NFO and thereafter. So, just to set the context, we'll be splitting this into three small parts. Ideally, we want this to run for 30-40 minutes, and then we can have time for Q&A. In the first 10 minutes, I would like to give a brief synopsis of what we are trying to do in this healthcare fund that we have. The second 10 minutes, my colleague Harsh Bhatia, who tracks the pharma sector or healthcare sector at Bandhan, will give an update on the recent earnings. We have seen Q3, how the earnings of the four themes that we have panned out, and also a view on the outlook for each of the subsegments. And in the last section, I would like to look at our current portfolio construction and also our view on how we want to construct the portfolio, how we look at the space going ahead. So I think just to start, so this is just a throwback or refresher to that extent of what we are trying to do in this fund. So we think that healthcare is a structurally diverse theme. Also, it plays into the longer term trends of aging population and falling birth rates, coupled with increase in chronic ailments. So I think that is why we think it's a structural theme and it's quite a diverse theme as we go into this forward. The first part of our thesis is that with falling birth rates in India and longer life expectancy, the median age of our population is only expected to go up. As we had presented during the NFO as well, we are at 28 years median age, expected to go to 38 over the next 20-25 years. When this happens, the share of spending towards healthcare will go up quite meaningfully. We have also looked at a case study like the US when they went through a similar transition in terms of their median age. Their healthcare spends as a percent of GDP went from 9% to 20%. Currently, we are in the 3 to 4% ballpark. So, as we age, the healthcare spends as a percentage of GDP are expected to go up, which means that the sector will grow faster than the nominal GDP growth of the country. That is why we call it a structural bet. It's an evergreen sector, though this doesn't guarantee that the returns will be linear. In all equity markets, there are ups and downs. But given the nature of healthcare, it's a less volatile sector. This sector typically tends to outperform in a bear market and underperform in a bull market. That is the nature of the sector. But what we expect is compounding higher than the nominal GDP growth over the medium term. So that was the thesis. Then, if we look at the breakup of the sector, now it's quite a diverse sector from what it was a few years ago. So we have split the BSE Healthcare Index into four distinct subsegments. If we go back to 2015, which is the left-hand side of this chart, we see that 68% of the index was comprised of companies which are export generic in nature. So the primary function or the primary business model of these companies was generic exports, and the rest of the segments were very small. Now, if we see, the market has broadened out with newer listings and some of the existing companies becoming large. We have four distinct segments in the market: domestic brands, hospitals, CDMO, and export generics. And each of these segments are between 20 to 30% of the index as such. So the nature of the sector has evolved over the last 10 years. Also, the depth has improved quite meaningfully. So here we put out among these 4 5 sub segments that we are looking at. Each of the sub segments has a depth of around 25 to 30 stocks. So there are around 130 or 135 stocks in the BSE Healthcare Index, with around 25 30 stocks in each of these four sub segments, which includes hospitals, domestic brands, CDMO, and generic exports. So that is our thesis. We also believe that each of these four sub segments are quite disconnected from each other. What happens in hospitals is very different from what happens in CDMO, which is very different from what happens in domestic branded drugs. So, which gives us a good amount of diversification within the sector. So, for example, if we throw back to the period of 2015 to 19, those were four very bad years for the pharma sector in India. That was the period where generic pharma went through a very, very bad phase. uh, uh, the chances of that repeating now are low, given that no segment is a is very significant for the index. All the four segments are around 20 to 30% of the index. So I think that is the broad concept or thesis for the sector. If we come to what we are trying to do in the fund, so most of these slides we have covered also during the info, so I'm not running through them right now. But let me come to what we want to do in our fund. So the idea is to have a balanced portfolio. So this is a thematic fund. Whenever we think of thematic funds, the first thought that comes to mind is that it's a high risk product. But that is where we want to be different. We do not think that pharma or healthcare is a 1 2 year opportunity and we have to take the maximum risk to generate alpha. In some other sector, it might be true that if we think that the next 1 2 or 3 years are going to be great for this sector, you try to buy the stocks where the delta can be the maximum over the next 1 or 2 years and generate that alpha. For us, we believe that this is a structural sector. We believe that structurally healthcare can grow 2 to 3% higher than the nominal GDP growth of the country. So if we are able to add 2 3% alpha over that, so that's a very good outcome. So the way we construct our portfolio is while looking at risk reward, we do not want to construct a high risk, high return sort of a portfolio. Wherever the fundamentals match the valuation and where we think that the risk reward is appropriate, that is where we will go and invest. So that's the broad thesis. In line with this thesis, we'll have around 20 to 30% allocation in each of these four themes of hospitals, CDMO, exports, and domestic branded. Uh, uh, this also at times it can happen that the fund manager is tempted to go 0% on say CDMO or 50% on say hospitals. The idea is to maintain the discipline. Near term, there can be ups and downs for each of these subsegments, but we believe that over the medium to long term, each of these subsegments can deliver meaningful returns. To maintain the discipline, the idea is to have a balanced 20 to 30% allocation. Again, for stock selection, we'll use the traditional filters: management quality, valuation, growth, ROC, etc. But on top of that, we look at segment specific filters or subsector specific filters, because these four segments are very different from each other. When we evaluate companies in hospitals, we are looking at a very different criteria like regional demand supply dynamics, capacity expansion pipeline, brand recall, etc. And this will be very different from, say, when we are evaluating a CDMO company. There we are looking at the pipeline in terms of drugs in various stages of clinical trials, phase one, phase two, phase three, or close to commercialization. We are looking at companies with high shares of sales to innovators, etc., etc. So the idea is that we apply strong bottom-up filters to each of these sub-segments, and that is where our bottom-up stock selection comes from. So I think that's the broad concept. Risks, I think we know it's a sectoral fund. So there is a chance that the entire sector of healthcare as a sector itself can underperform the market. Healthcare, as we know, is a low volatile sector. It's a defensive. Defensives typically underperform in bull markets and outperform in bear markets. So that is one risk that we have to be careful of. Also, each of the subsegments has regulatory risk. Hospitals are regulated by the Indian regulator. Generics and CDMO are regulated by the FDA. So there can be regulatory risks that arise from time to time. What we suggest is obviously this fund can't be a core allocation, but if we think from a medium term perspective, for our personal lives, healthcare expenses and healthcare inflation always goes up much more than the overall inflation. So this healthcare inflation going up would invariably benefit companies like hospitals, pharma companies, etc. So this is a good way of hedging against healthcare inflation to that extent. So what we suggest is a satellite allocation to this, where 70-80% of any investor's portfolio would be in core funds, the diversified, large mid, flexi, etc., etc. The 20-30%, which is the risk part of the portfolio, can carry this fund as one of the allocations to that extent. So that is what we are looking at over here. So again, about healthcare, so it's an evergreen theme. It's a sector that can grow faster than normal GDP growth for a reasonable period of time. Rising median age, increasing prevalence of chronic diseases, and high healthcare inflation are very relevant themes. And now is a good time because valuations also have come off over the last 18 months as such. Why Bandhan Healthcare Fund? Again, what we are trying to do here is run a balanced product, moderate risk reward, and no sharp tilts to any particular subsector, and no significant. The idea is not to take huge amount of risks in the fund to that extent. So that is where I wrap it up on the fund philosophy and thought process. I will hand over to Harsh to give a brief on the earning season gone by and also the outlook on each of the four subsegments from an earnings perspective. Over to you, Harsh.
I'll just quickly run through a couple of pointers, keeping the time in mind. What we're trying to basically show in this slide and the next slide is what our thought process continues to be, what we look at in terms of the results, and what we think is very important for the next 2 to 3 year perspective. Uh, Quickly diving into, as you can see, the domestic pharma segment, right? Both from a quarter perspective and the last 9 to 12 month perspective, generally what we have seen is that the domestic pharma business across the industry, the domestic segments for multiple companies has delivered a very decent level of growth rate. Some companies are still at high single digit growth rate. Some companies are delivering mid to high teens growth as well. Now, this is something that has particularly surprised investors from a third quarter perspective. What can be a driving factor across multiple other factors could be the recovery in both chronic as well as the acute divisions. What's also happening is that certain smaller and mid-sized companies have decided to enter new therapies and new segments. For example, women's healthcare, urology. These are the couple of 2, 3 therapies where we have seen incremental companies come into the space. What it also leads to is in terms of market expansion, awareness for certain diseases which are not yet prevalent or as much aware in the India market. Uh, uh, what I wanted to also touch upon within the domestic pharma as an example that we have seen play out is one of the largest domestic pharma companies, which is more than 20,000 crores in terms of top line. Two things have happened, and this is very important for us to sort of keep things in sync. Is that their presence in chronic is helping them deliver above level market growth rate consistently for the last 1 to 2 year period. Now you have to keep in mind that at that scale, them being able to deliver at 13-14% top line growth is phenomenal. Uh, Their presence on the chronic side, as well as their ability to add MRs and execute on that, has been very healthy. I think that continues to be very, very favorable for that company. So I think that's those are the two or three very important aspects from a domestic pharma perspective. Quickly coming to the export generic market, I think overall from a quarter perspective, as well as the last few quarters, generally the growth has been pretty muted as such from basket approach. Yes, there will be certain companies who will grow at 8 to 10%. There will be certain companies who will be declining 5 to 7%. But overall, from a basket approach, what we are seeing is a mid single digit decline from an overall company level perspective. Now, the export generic space continues to be dependent on a couple of factors, which is obviously your products, price erosion, and your regulatory part of the business, which I think Viraj also alluded to earlier. Um, Certain companies continue to see improving pipelines, improving commercialization rates, and improving level of price erosions depending on what kind of products they're able to supply in the market. Um, the other point that also is panning out since this quarter as well as the last quarter is that currency benefits. So INR depreciation against other currencies, specifically dollar as well as euro, has substantially helped multiple companies, both from a top line perspective as well as margin perspective. So that also in turn helps companies deliver on overall expectations. One example, as I did for domestic pharma, similarly for export generics, one of the large US generic focused companies. Um, 2 to 3 years ago, or 3 to 4 years ago, their top line for the US business was close to 600, $700 million, and the business was hardly profitable. But as things stand today, that business is close to 1.2 to $1.3 billion from a US market perspective. And that has substantially improved the profitability of the overall US business. What has happened in the last 3, 4 years is that their overall focus on the R&D and complex products has started to pay off dividends. This company started to invest a lot into the US market in 2019 and 2020. And now they are reaping all of those benefits. Within complex products, especially respiratory, complex injectables, 505(b)(2)s, all of those products are filing pretty well. So I think that's what we are seeing in the last 2, 3 years, wherein their top line has moved from a $600, $700 million to almost a 1.2 to $1.3 billion number. Uh, Overall, what gives us confidence is that their pipeline visibility continues to improve significantly. So for the next 2 to 3 year perspective, I think the growth potential can be pretty phenomenal for this particular company. I think, Viraj, we can go to the next slide. Yeah. At the hospital level, I think broadly from a sectoral perspective, 3 or 4 important points. I think from a top line growth perspective, generally what we are seeing is that at the sector level, a low to mid teens top line growth rate is something that has broadly panned out over the last couple of quarters. There are certain companies which we continue to like. Certain of those companies have delivered growth about 20% from a top line perspective. So that's pretty phenomenal. Um, Incrementally, one other factor that we really want to highlight over here is that the brownfield additions that these companies have been talking about generally have broken even in a very small period of time, less than 6 months in most of the cases. In some cases, it is 3 months as well. uh, uh, there are certain greenfield additions as well that has been happening at the sectoral level, but a large part of the sectoral EBITDA drag continues to be driven by the greenfield additions. I think what continues to drive the sector is obviously insurance penetration, improving case mix and payer mix, as well as market-led bed expansion. uh, One example I would just quickly highlight over here is there's one of the large South-based corporate chains, right? A couple of years ago, they were at 3,500 bed capacity. Today, they are closing it at 5,500 bed capacity from a bed capacity perspective. The next couple of years also, they will add almost 30 to 40% to their capacity. Uh, More importantly, the reason that I'm highlighting this point is that a good portion of their expansion has been greenfield in nature. So yes, we do understand that there will be sectoral level drag from a company perspective because it is greenfield in nature, because it will take time. But the type of execution that they have showcased, right, from a greenfield addition perspective, from understanding the market, bringing in the right talent, and turning around the particular asset in, let's say, less than 12 months, in certain cases, has been pretty phenomenal. I think they have a particular playbook advantage, and if they are able to deliver on these particular assets in greenfield markets, is something that they will be able to deliver going forward as well. So I think that's something that's pretty positive. On the CDMO side, lastly, one thing that we always keep in mind is that the CDMO business, because of the nature of the business by itself, because of the buying patterns, and the overall function of how the drug performs, it's a pretty volatile sector per se, right? You'll be some quarters where you'll be seeing phenomenal growth, and some quarters where you'll be seeing a very muted growth. Within this quarter itself, what we are trying to highlight is that there are certain companies who have seen a 20 to 30% decline from a top line perspective, and there are certain companies who have delivered more than 25% growth from a top line perspective. But what we are also trying to showcase over here is that it is better to look at it from a longer term perspective, a slightly longer period. In this case, if we look at it from a 9-month perspective, then most of the companies are at least 15 to 20% growth. Yes, there are a few exceptions which will be on a decline of 5 to 10%, but most of the companies have delivered in that average of 15 to 20% growth from a top line perspective, slightly higher probably at the EBITDA level. And from a sectoral perspective, I think what continues to be important is how their pipelines continue to improve, how phase two, and phase three pipeline continues to improve, uh, what kind of contracts and conversations they are having with the innovators and big pharma, and what kind of capacity expansion, technology expansion they are able to bring in about into their own business. Overall, CDMO India continues to be very, very favorably positioned from both from an R&D perspective, scalability perspective, and obviously the most important point being the cost advantage as well as diversification. So I think these things are starting to pan out. We are seeing constant conversations with companies, and a lot of things are happening on ground. Last point to conclude over here, just on the CDMO part, is one of the companies that we continue to like is. Uh, 3 to 4 years ago, this particular company had a top line of close to $110 million on an overall business. As things stand today, the top line is broadly at a run rate of $250 million. So that's almost 2.5x of where they were 3 years ago. What has driven this is obviously broadly two parts. One is the phenomenal pipeline that continues to play out. I think that continues to be overall going off pretty well. They have certain molecules on the cancer side, on the ophthalmology side, on the diabetes side that continue to do pretty well at the end market. And the second point is obviously their ability to execute on both capacity expansion as well as technology, through which they're able to attract clients. So I think these two factors are the most important things that are helping them deliver such level of growth in the system. So I think these are the broader points to keep in mind from a subsector or a subsegment perspective as such, and what we continue to like in these segments as well as the companies. So yeah, Viraj.
As for the update, so I will just quickly wrap up on the current portfolio, how are we positioned, and then we can open the floor for Q&A. So I think this is how the portfolio is structured. It's a quick snapshot to that extent. So if we look at the top left, we are largely in line with the large cap versus mid versus the index. So our large cap weights are now in line with the large cap weights in the index. Our overall SMID weights are also in line with the SMID weights of the index. The only caveat being that we are underweight mid caps and overweight small caps. We mid caps in general are quite expensive, not just for healthcare but across the broader market. We find more value in some of the smaller companies where the price correction over the last 6 9 months has been quite severe. The second way we look at it is we look at the mix between we classify these companies into high growth, GARP, and value. So we are currently overweight the GARP and value buckets because some of the high growth companies continue to be very expensive. So in those pockets where the valuations we are okay with the valuations versus the growth trade off, we are there. But generally, some of the more steadier, decent quality, stable growth companies are today trading at valuations which are quite attractive. Uh, and lastly, the cut on the index four subsegments that we highlight. So as we said, largely our weights in each of the four segments are in the 20 to 30% ballpark, with domestic pharma being the highest at 29%, hospitals at around 27.5%, exports at 21.5%, or the generics at 21.5%, a CDMO at 17.5%, and others at 2.5% with 2% cash. So we are fully deployed, and we have roughly between 20 to 30% exposure to each of the four subsegments. Now, how do we look at it going forward? Again, so yes, we will continue to bet on the four themes with 20 to 30% in each of them. Again, reiterating, idea is not to run a high risk, high return fund, but to build a balanced fund which can generate consistent, moderate outperformance over the index. What are we looking at incrementally? So when we first deployed, we were putting most of the money in the larger companies in the domestic pharma oriented companies or even some of the generic export companies because we found value over there. But over the last 2 quarters, we have seen significant corrections in some of the hospital stocks as well as some of the smaller CDMO companies. Incrementally, we have been buying those companies wherever we think that the valuations are now okay and the company has some inherent strengths that it can overcome the near term weakness to that extent. As Harsh pointed out, in many of these cases, the 9 month numbers are okay, but there has been a lot of dislocation because of the tariff impact. So there was front loading that happened in terms of imports in the US in the first 2 quarters. And then there has been a destocking in the next 2 quarters to that extent, which has resulted in very weak Q3 and even Q2 for some of those companies. The longer term numbers are okay, the longer term opportunity is quite okay, but some of the price dislocations give us a good opportunity to buy some of these stocks. The same is the story with hospitals. With the ramp up of greenfield hospitals, margins of some of the companies are under pressure. We believe that this is a near term thing, and we have been again adding some of the names over there as well. Again, the idea is to build a portfolio with the next 3 years in mind and not the next 1 or 2 quarters. So we are not necessarily buying the companies which will generate the best results or the best earnings for the next 1 or 2 quarters. Because in a lot of cases, the valuations fully price in the positive near term outlook as such. The idea is to invest in companies where the delta can be quite meaningful over the next 3 years, where the companies are going through a bad earning cycle, valuations are cheap, etc., etc. Uh, so what this may result in, especially as we buy into some of the stocks which are correcting, we are okay to take pain in some of these stocks for 1 2 quarters because it's very difficult to time the bottom very exactly. So in a lot of the cases, we know that the valuations are somewhere close to the bottom, but can the stock fall 10% from here or 15% from here? There is no one who can accurately guess where the exact bottom of the stock is. So we are slowly accumulating a lot of these ideas. Idea is to build this portfolio, continue building this portfolio for the next, with a view that over the next 3 years, these companies should be able to give meaningful delta, even though the next 1 or 2 quarters might be weak or may not be the best as such. So that's the thought process. Again, we are thinking it from a medium term perspective. We do not think it's a near term opportunity. We think that it's a medium to long term opportunity where growth can be significantly higher than the overall market, and our endeavor is to deliver moderate, consistent outperformance over the index as such.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.